Good morning. I'm Andy Myers at Weiss Research.
I'm Jen Amos, and this is your morning market alert for Monday, August 8th. Stocks on Wall Street are coming off their worst week in years, and this one looks like it will start in the same way. Futures are sharply lower after Standard & Poor's cut its AAA credit rating on the United States debt to AA+, the first downgrade on U.S. debt in history. In addition, S&P lowered its outlook, threatening another reduction in 2 years. The rating agency said the deal reached by lawmakers to cut the federal deficit by more than $2 trillion over a decade didn't go far enough, and, quote, America's governance and policymaking is becoming less stable, less effective, and less predictable than what we previously believed. The announcement came after the close of trading on Friday, and it was not a surprise to many investors, but it's still having a dramatic impact on the global markets. Right now, stocks across Europe are falling sharply after a similar sell-off in the Asian markets. China, the largest holder of U.S. debt, saw its Shanghai Composite tumble nearly 4%.
Following the downgrade by Standard & Poor's, traders around the world are searching for safety in the markets, and for many of them, that means gold. The precious metal is surging $60 an ounce, breaking the $1,700 mark for the first time ever. It had reached as high as $17.18 an ounce earlier in the session, and many analysts think it will go even higher. Goldman Sachs raised its forecast for the precious metal, noting that economists now see a 1 in 3 chance of a U.S. recession within the next 6 months. Goldman boosted its 6-month target price on gold by nearly $100 to $1,730 an ounce, and said it will reach $1,860 an ounce within a year. Goldman also raised its silver forecasts, but silver is already trading well above their target prices at nearly $40 an ounce. Meanwhile, oil is moving in the opposite direction as traders move away from riskier assets and grow more concerned about slowing demand from the U.S. and other economies. Right now, crude is slumping nearly 4% to below $84 a barrel.
We're also seeing a dramatic reaction in the bond and currency markets, but they may not be moving in the direction you expect. U.S. Treasuries seem to be retaining their safe haven appeal. Prices are rising, and the yield on the 10-year Treasury bill is now back below 2.5%. The 2-year note, meanwhile, is yielding less than 0.3%. Many analysts think the long-term trend for the dollar will be negative, but for the moment, it's holding steady and actually gaining ground against the euro. If anything, traders have even less confidence in the Eurozone economy and its shared currency. They're concerned that the sovereign debt crisis that has engulfed Greece, Ireland, and other countries will spread to larger nations such as Italy and Spain. As a result, the European Central Bank moved to calm the markets over the weekend, saying it will actively implement its bond buying program. The plan seems to be working so far. Interest rates on Italian and Spanish debt are moving sharply lower.
We do have some corporate news to tell you about today. Tyson Foods is among the biggest names on the earning calendar. It reported a decline in fiscal third quarter profit, but the results topped estimates, and Tyson shares are set to open higher. Meanwhile, net income at Warren Buffett's investment firm Berkshire Hathaway jumped 74%. However, operating earnings fell 12%, as the company's insurance operations, including Geico, recorded a loss. Following the results, Keefe Bruyette upgraded Berkshire to outperform, and the stock is rising in the pre-market. Separately, a Berkshire Hathaway subsidiary, National Indemnity, offered to acquire all the outstanding shares of Transatlantic Holdings. Despite the bid, Transatlantic's board continues to recommend a stock swap merger with Allied World Assurance that it agreed to in June. That's the latest from Weiss Research. Have a great trading day.